Let's talk about Chapter 20. Chapter 20 is about income tax on trusts and estates. So we'll talk a little bit about what trusts and estates are, how they're formed, all that good stuff. And so the big picture this time deals with Anna Jiang or Jiang. I'm not sure how to say her name. Main breadwinner in her family. Her husband Tom is a social worker, and two children, Bobby and Sally. Anna has accumulated about $2 million in after-tax investment accounts, largely made up of growth stocks that did not regularly pay dividends. She inherited these when her grandmother passed about 5 years ago. She's addressed the problem of probate costs through joint property ownership, life insurance policies, and beneficiary arrangements for her retirement plans. So she and Tom also update their wills every 5 years or so. She has a family history of Alzheimer's. She wants to make certain that Tom and the children will have adequate cash flow from the $2 million of investment assets if she's unable to work. So one of Anna's colleagues suggested that she set up a trust to take care of her family in case a medical problem ever arises. And so basically then read the chapter to formulate kind of what the rest of the story is or what she should do with that information. And so the first part of the chapter really deals with trusts. And I know they get covered a little bit in a biz law class, so I think everybody's kind of should have a vague remembrance or a little bit of information in their brains about what a trust is at this point of your careers. Now, of course, like the IRS code, nothing's really defined purposely, right? Not defined in the code usually refers to an arrangement created by a will or inter vivos, which means lifetime declaration. A trustee takes title to property for the purpose of protecting or conserving that property for a beneficiary. It's used to achieve various financial and other goals. Now, obviously, if you're going to form a trust, you would need to go through a lawyer to make that happen. That's kind of what they're meaning there. So typically, there are three parties. It would be good if you knew the three parties. I think a few of your homework questions, you'll want to know what those parties are, so just be aware of that. So the grantor transfers select assets to the trust entity. So the grantor is granting assets to the trust. The trustee is the person in charge of the assets, kind of the fiduciary duties. And the beneficiary will be the person to receive either the income and or the property from the trust. Now, the same person can be a couple of these parties at the same time. So it doesn't have to be three different people. It could be two people. The grantor and the trustee could be the same person. The trustee and the beneficiary could be the same person. A life insurance trust, which is a very common one, holds life insurance policies on the insured, removes proceeds of the policies from the gross estate if it's irrevocable, meaning that once the trust is set up, it cannot be taken back. And a good reason this is done is to safeguard proceeds by a young or inexperienced beneficiary. To basically say, let the trust hold the proceeds. A trustee then will be in charge of saying, the trustee will get, the beneficiary will get the proceeds at a certain age, or once college has a college degree has been earned. Whatever the grantor wants to set up. A living or revocable trust is to manage assets, reduce probate, provides privacy in asset disposition, protects against medical or other emergencies, provides relief from necessary day-to-day management of underlying assets. But that one is revocable, a living trust. So a trust for minors, again, and some of the reasons they're set up, provide college funds for education, shifts income to a lower bracket taxpayer, so less tax will be paid, allows parents to retain some control over children's use of assets, or a divorce trust, which manages the assets of an ex-spouse and ensures they'll be transferred to a prescribed schedule or name of beneficiaries. So it's kind of just a picture then of the three parties. The grantor contributes assets to the trust. The trustee holds title to the assets, makes investment and distributions as directed by the trust document, files a return, tax returns, meets legal reporting requirements. Trust terminates at times specified in the agreement, and the beneficiary then receives the income and or remainder, basically what are the assets that are left over. So what is it? So that now leads us to an estate. So that was all trust, and the trust information pretty much is on pages 2 and 3. So an estate happens when somebody passes away. Okay, so when somebody passes, that creates an estate. The death of every individual collects and conserves individuals' assets, satisfying all liabilities, and distributes the remaining assets to the heirs. Typically along the lines of what's been defined by a will. If there wasn't a will, the state essentially creates a will for you based on state law. So here you have the decedent, and the persons who's passed away, assets and liabilities are transferred to the estate. The executor manages the assets during this administrative period, pays off final bills, including any estate tax, distributes net probate assets written by the controlling will. It terminates when all required activities have been completed. And then beneficiaries receive income and or the remainder depending on the wishes in the will and so on. So nature of trust and estate taxation, which is really what this chapter is about. This begins on the bottom of page 5. So in general, taxable income of trusts or estates is taxed to the entity or to its beneficiaries to the extent that each has received the accounting income. So the key is, what is the accounting income and who has received it? Has it stayed within the state, within the trust or the estate, or has the accounting income been transferred to a particular person? So filing requirements then, must file a Form 1041. And then within a state with gross income greater than $600. For a trust that either has taxable income or if no taxable income, gross income of $600 or more. Due on the 15th day of the 4th month following year end. Okay. So tax periods then, tax year is the estate can either use a calendar year or a fiscal year. A trust must use a calendar year. And then payments out of these, trusts and estates are required to make quarterly estate tax payments using the same schedule as individuals. Applies to estates and grantor trusts only for tax years ending in 2 or more years after the date of the decedent's death. Charitable trusts and private foundations are exempt from making estimated payments. You do get some exemptions with these. It's pretty small though. Estate 600, civil trust 300, and everything else is 100. They may be subject to AMT or alternative minimum tax, and you can see here generally it's the same kind of a calculation for trusts and estates as it is for individuals. Also, there is potentially an additional tax on net investment income. So it's a 3.8% tax. Applies to undistributed net income that's over $12,500. So NII includes gross income minus any deductions from interest, dividends, royalties, rents, passive activities, not recognized gains from the disposition of assets. So, think of the estate of somebody who's famous, whose estate is continuously receiving royalties, right? That's probably going to be one of the examples to use there. And so this chart right here is on page 9. Accounting income, what they call DNI, distributable net income, and taxable income of the entity and the beneficiary. So step 1, determine accounting income of the entity. Step 2, compute entity taxable income before distribution deduction. Step 3, determine distributable net income and the distribution deduction. In other words, who's going to receive the money, if any. Step 4, compute entity taxable income, basically taking step 2 and subtracting step 3. That leads us to step 5, allocate the DNI, the distributable net income, and its character to the beneficiaries using a tiered system if necessary. Okay, and then the very bottom of page 9, they kind of show us the template that we would use to go through that 5-step process. So entity accounting income, probably part of step 1, probably well, definitely an important thing to remember here. It's based on the controlling document. Okay, so either the document or state law determines whether the amounts are allocable to corpus or current income, and corpus is assets. If the entity distributes income currently, that income should generally correspond to accounting income. So common allocations, either income or corpus, and you can see here what those are, and this exact same thing is on page 11. At the very top of page 11 is where you'll find it. And you can see here income is ordinary income, operating income, interest, dividend, rent, royalties, dividends, half of fiduciary fees and commissions, and then allocable to corpus, depreciation, casualty gains and losses, insurance recoveries, capital gains, stock splits, 1/2 of fiduciary fees. So corpus, think of more applying to assets, and then income is just ordinary income minus expenses. So generally, estates and trusts act as conduits for income received, and taxation is at beneficiary level. Okay, this is codified through allowance of a distribution deduction. Exceptions, of course, there's always exceptions, right? Complex trusts accumulate income for specified times, like, for example, maybe until the beneficiary reaches a certain age. Okay, so that would be different. So nothing can be distributed until the person meets certain requirements, like age. Estates are not always required to make current distributions. Either in these cases or other cases where the entity is not required to distribute current income, the entity itself then becomes taxed. So property distributions, generally the entity does not recognize gain or loss. Beneficiary takes the same base as an asset as it had in the estate or trust. So the basis just transfers along. Distribution absorbs distributable net income and qualifies for a distribution deduction to extent to lesser of base of the beneficiary, fair market value on date of distribution. And then property distributions, the trustee or executor can elect to recognize gains and losses on assets distributed in kind if they would like to. And so let's come back to the big picture. Our family, so Anna, she established the Jiang Family Trust. The trust distributes a painting, a basis of $40,000, fair market value of $90,000, to beneficiary Sally. And so Sally, remember Sally is one of the children. Sally's basis in the painting then is $40,000. The distribution absorbs $40,000 in the Jiang Trust D&I, distributable net income, and the trust claims a $40,000 distribution deduction relative to the transaction. Okay, so deductions allowed. Deductions are allowed for ordinary and necessary expenses for trade or business, production of income, management, conservation, or maintenance of property, determination, collection, or refund of any tax. Some other deductions that are allowed. No deduction is allowed for expenses related to the production or collection of tax-exempt income. Cost recovery deductions are allocated proportionately, and deductions are allowed for casualty or theft losses. And then charitable contribution deductions is allowed to the extent of amounts included in gross income for the year. Okay, so a trust can make charitable contributions. So coming back then to the big picture, again, Anna's established the Jiang Family Trust. Gross rent income of $80,000, expenses attributable to the rents of $60,000, tax-exempt interest from the sale of bonds is $20,000. Under the trust agreement, the trustee is to pay 30% of annual trust accounting income to the United Way, a qualifying organization. So accordingly, the trust pays $12,000 to the charity, 30% to $40,000, and the $40,000 is 80 minus 60 for 20 plus 20. And so 40,000 times 30%, which is 12,000, then goes to the charity. The charitable contribution deduction allowed is 9,600, even if the payment is not made until the following year. So it's 80,000 divided by 100,000 times 12,000. So the 80,000 here, the 20,000 here, that's 100,000. Oops, and then clicked on the wrong slide. And then take the 80 divided by the 100 times 12 at 9,600. Assume the same facts, so change it up just a little bit, except that the trust instrument also requires a contribution be paid from the net rent income. The agreement controls and the allocation formula need to be applied. You can see here is the entire $12,000 is now a charitable deduction, so we don't have to worry about that formula because the trust document says it all comes from the rent income, so you don't have to allocate it like before. So your DNI, distributable net income, entity is allowed a deduction for distributions to beneficiaries. Distributable net income is used to compute the amount of the deduction, the maximum amount the beneficiaries pay tax on, the character of the income, and the maximum amount of distribution deduction. So to calculate this, step 1, determine their income before distributions deductions. So it includes all of the income, deductions, gains, and losses. And then step 2, make the following adjustments on taxable income. Add back the personal exemption, net tax exempt interest, net capital losses, subtract net capital gains allocable to corpus. And then for estates and complex trusts, the distribution is a lesser of whatever the deductible portion of DNI is or the taxable amount actually distributed. For a simple trust, the full distribution is always assumed. So here's how you calculate the entity taxable income. So entity taxable income before the distribution less distribution deduction equals the entity taxable income. So then allocation of DNI. Each type of DNI must be allocated proportionately to income beneficiaries. So it prevents manipulation of tax liabilities by assigning tax-exempt income to a high bracket taxpayer and taxable income to low bracket taxpayers. So the amount taxable to beneficiaries for a simple trust is the DNI is the maximum taxable amount. May be less if DNI includes tax-exempt interest, and if more than one income beneficiary apportion elements of DNI rateably. The amount taxable to beneficiaries for estates and complex trusts will use a two-tiered system. Income required to be distributed is categorized as first-tier distribution. Everything else then is second-tier. So here's the formula for doing that. It says here the amount taxable to beneficiaries if only first-tier contributions are made and those amounts exceed DNI, use the following formula to allocate DNI among beneficiaries. So first tier divided by first tier distributions to the beneficiary divided by first tier distributions to all beneficiaries times whatever the DNI is equals that person's share of income. So it's ratably applied. You can kind of see that with the formula. If first and second tier distributions are made and first tier distributions exceed DNI, use the previous formula to allocate first tier distributions. Second tier distributions are not taxed since all DNI has been allocated. So then the amount that's taxable to beneficiaries, if first and second tier distributions are made and first tier distributions do not exceed DNI, but the total of both first tier and second tier distributions does not exceed DNI, the second tier beneficiaries recognize income as shown below. So you take your second tier distribution to beneficiary, divided by all second tier distributions, multiply that by whatever's left over, remaining distribution after the first tier distribution is that beneficiary's share of distributable net income. Okay. So then for the sole purpose of determining the amount of DNI for a complex trust or an estate with more than one beneficiary, the substantially separate and independent shares of different beneficiaries in the trust or estate are treated as separate trusts or estates. The separate share rule is designed to prevent inequality that results in the corpus payments are treated under regular rules applicable to second tier beneficiaries. And also it kind of matters the character of the income. Various classes of income retain their character and flow through to beneficiaries. If all D&I is distributed, then there are multiple beneficiaries must allocate various classes of income. Okay. And then just an example of that. So the Alto Family Trust has the following income and expenses. So interest income, tax exempt, capital gain, and then fees. And it says it allocates the fees to trust income. Capital gains go to corpus. Accounting income is as follows and is distributed to Sue, who is the only beneficiary. And you can see here we have interest income, tax exempt income, and then the fees to get to accounting income of 12. Fiduciary fees are allocated between interest income and tax exempt income before calculating trust taxable income. So interest income times fees, and then total income. So you can kind of see what that is. And then we split that out, tax exempt. Okay, so we kind of split it out, multiplied by the fees. Taxable income to the trust before distribution deduction is as follows. The capital gain, interest income, the fiduciary fees related to interest income, the exemption, and then we get our number. Okay, and it says here net tax exempt income is $6,000 less $857, or the 5143. And 857 was from right there. Okay, and then the D&I, tax exempt income before D&I, plus your exemption, plus your tax exempt interest income, net of expenses allocated to tax exempt income minus capital gains allocated to corpus. The distribution deduction is a lesser of the amount actually distributed, $12,000, or D&I net of tax exempt income plus expenses. Determine trust taxable income after distribution deduction. You can see what that is then. Tax is limited to 15% since income is from capital gains. And then we can do this calculation here. Allocate D&I as character to the beneficiaries. D&I to Sue is $12,000, consisting of the following. So the gross income, which is interest income, tax exempt $14,000. We split the fees between exempt and non-exempt, her net income by category. So Sue receives $12,000 from the distribution. She pays tax on $6,857 because some of it, of course, was non-taxable. She lost deductions of $857 for fees allocated to tax-exempt income. Then coming back to Anna, she should consider the creation of one or more trusts. You can see here that some suggestion for the family might be Anna transfers some or all the $2 million in assets to the Jiang Family Trust with quarterly income payable to Tom and the children. And the recipients would be designated by the trustee, but all entities' accounting income must be distributed. In this way, the income would be could be directed to the beneficiary most in need, basically the kids, and children could be named first-tier beneficiaries, and Tom is the second tier. While Anna is still healthy and earning a regular salary, the trustee should accumulate the accounting income and allow the corpus to build. So basically, just build up that investment to a larger amount. It could, though, make gifts to charity or fund education plans for both Bobby and Sally. And it should provide clear instructions for the trustee as to your preferences and how the trust corpus should be invested, and specify which of Tom's and the children's expenses should be and should not be covered. Which should be and should not be covered. The children should be named as remainder beneficiaries of the Jiang Family Trust. In case the trust corpus exceeds the estate tax bypass amount, other remainder beneficiaries could be named in order to avoid any generation skipping tax, which we don't cover. Amendments to the trust document should be considered whenever Tom and Anna update their rules. What if Anna remains healthy? The trust might be terminated when the children reach age of majority. Right, so as the need for financial support will have diminished. If Tom is unable and willing to take over the management of the assets, the trust should continue. In this event, the trustee should be chosen from family members or business associates who know Anna and Tom well and familiar with their objectives. Then the trustee might shift the focus to funding long-term care for the couple, making charitable gifts, or financing education needs of grandchildren.